debate there on the risks surrounding inflation, either to the top side or the downside, it seems, but nearly all members agreeing that we need to start retracting the balance sheet.
Yeah, I would not put a whole lot on the idea of whether they're going to raise rates or not in June based on the minutes. Look at the data that we're getting right now. You and I were talking just before the program, and the minutes came out about how in the beginning of May, they were working off a jobs report that had come in very, very disappointing, and inflation that was up, and we've now reversed that. So it isn't clear exactly what they'll do, but if the data keep coming in strong and we get a lot more data between now and the June 14th meeting, they'll probably go again. So it doesn't tell you a whole lot. The interesting thing is we're making progress on the balance sheet and where we're going with that, how they are going to do it. You can pretty much check the box on by the end of the year because the minutes say almost everybody agreed on that. And the other thing that they agreed on is this idea of caps or monthly limits. They want it to be a regular and predictable system, but they also want to taper it. They don't want to shock the markets right away. The minutes say nearly all policymakers expressed a favorable view of that approach. So it looks like the taper idea is going to be done. The staff idea of changing it every 3 months makes some sense. And if we can go to my Bloomberg here, I'll show you why. When you look at the distribution of the Fed's holdings in 2018, this is the bar chart in the upper left-hand corner. I can't make it bigger, unfortunately, but you see that there is a significant amount of holdings that are going to roll off early in the year. And as you move towards 2022, that declines. Yep. So you've got to deal with the fact that every month and every year, you're going to have different amounts coming off at different times. And there's a front load into 2018. So if you have caps that you can adjust, you can take account of that.
And they've got to do it pretty quickly because, of course, 2018 is the year when it really kicks in.
Yeah, I was just looking at the market reaction as well as, Mike, you were speaking, and the 10-year yield drifting as well. It was drifting higher before the announcement. The FOMC minutes were released, but now it's at session lows. We also see the dollar at session lows and the break even on the 10-year coming down quite a bit, off by 1.2% at the moment. When it comes to the balance sheet reduction, it sounds like they're applying a rules-based approach.
That's what they want to do. They want to have this be what they call regular and predictable and run in the background. Once they get started, except for the caps, which will reflect the amount in dollars that will be reinvested each month, once those are fully phased in after a year, then the Fed can just set it and forget it. They don't want people thinking that they're going to back off or go forward with it depending on economic conditions. They want it just to go to their preset target. The target is what we still don't know yet.
And the critical question here is, what do they back off on then? Is it on rate rises, or is it once they've set this program in form if inflation indeed disappoints in the second half of this year?
They would prefer to use the Fed funds rate to target that and not use the balance sheet. They would keep the balance sheet in reserve if we had another big downturn and we were still too close to zero or at zero on the Fed funds rate. But what they hope to do is be able to raise the Fed funds rate, get about 200 basis points so you've got some room to cut should we see a downturn.
Dry